Hello, everyone. Good afternoon. I'm Nneoma from Stable Lab. Welcome to this discussion on one of the most dynamic intersections of finance and blockchain, that is real-world asset-backed yield-bearing stablecoins. Quite a mouthful, right? I'm joined here by my fellow panelists to discuss this topic that really sits at the heart of the intersection of TradFi and DeFi. Stablecoins are the backbone of crypto markets today. And the conversation has shifted more from just mere stability and more so to yield, value accrual, and governance. And today we're going to be touching on a couple themes: how this yield is captured and distributed, whether these instruments are actually serving to onboard more institutions or just providing more sophisticated tools for existing crypto users, so degens and power users alike, and how the design of these stable coins are serving the needs of both DeFi and TradFi participants. So I think we could kick off with a few intros just across the stage, just a couple lines about what you do before we kick off.
Maybe I'll start. Hi, everyone. Emanuele, Rossi here. I lead sales and business development at Mountain Protocol. Very briefly, Mountain Protocol is the issuer of the first regulated, permissionless, yield-bearing digital dollar called USDM. The idea behind USDM is very simple. We've taken the barrel-tested approach of stablecoin issuance pioneered by many centralized players, fully reserved, over-collateralized by treasuries. We've enhanced it through bankruptcy remoteness and prudential regulation. We've kept the same type of integration dynamics that we're all familiar with and that we all love about crypto, permissionless ERC20 tokens, and we've then enhanced it through the yield component, meaning that holders of our digital dollar not only have access to a dollar, but one that pays daily rewards simply by holding it directly in your wallet. There is no staking, no lockups, no claiming of the yield. You simply hold USDM, you get rewards paid out in your wallet. Our goal is very simple: to build a safe financial product that can be used by anyone in the world, whether you're a sophisticated financial institution or Joe Schmo in the middle of nowhere looking to save a few bucks while earning some interest on it. Nice to be here.
Hey everyone, my name is Jen Senhaji. I lead BD and growth at Chronicle. Chronicle is an Oracle protocol. It started back in 2017 within MakerDAO, so it's actually the first Oracle built on Ethereum. We spun out of Maker, now Sky, almost 2 years ago, and our two main products are crypto price feed, so any type of crypto asset that needs pricing information for protocols. Our infrastructure supports that. And then we also have a product called Verified Asset Oracle, which is servicing the tokenized asset space. So off-chain funds who are tokenizing assets like T-bills can bring them on-chain in a manner that's very transparent and verifiable through our Oracle infrastructure.
Hi. By the way, I'm wearing Oracle socks today, even though we're Oracle-less. Sorry, Chronicle and Oracle. Yeah, I'm Johannes. I'm the managing director of the Frankencoin Association. I'm Swiss. But Frankencoin is a completely decentralized Swiss franc stablecoin, and that's really what we're doing. We're building that alternative to the US dollar because we believe that there's a pretty big space, especially for store of value for the Swiss franc on-chain. Now, that's just kind of the value prop, but behind that, there's a bunch of really interesting stuff. So while I'm wearing Chronicle Lab socks today, we're actually Oracle-less, so we are having a liquidation mechanism that is completely working without oracles, and that allows us to have a wide set of different types of collaterals, such as real-world assets. We have some Swiss equity, actually, which is issued on-chain, as a small part of our protocol, and just we solve kind of a bunch of those issues which decentralized stablecoins have with that design, and scaling it up and putting the Swiss franc on the map really.
I'm Jacob, Chief Growth Officer at M0. We are building a platform for developers, entrepreneurs, really any application to spin up a robust stablecoin to embed into their application. Our thesis is really that any financial application and distribution platform over the next 5 to 10 years is going to embed stablecoins, and we are helping those developers do just that. All stablecoins that are built on top of them, we call them extensions, benefit from our wholesale stablecoin M, and they maintain interoperability and all the liquidity we built for that network. And you can think of M as this wholesale atomized, collateral, proof of reserve, and sophisticated yield distribution mechanism.
Thank you all for those intros. Let's jump right in. Emanuele, USDM has quickly become one of the most notable treasury-backed stablecoins, and we'll dive more into the aspects of yield and how it's being distributed, but I think it's really important to set the broader landscape. If you could quickly give us a primer on yield-bearing instruments that exist in the market today and how they compare in terms of risk, integration dynamics, and adoption overall.
Yeah, so I think there has been so much focus and attention over stablecoin the last few years because they are very profitable business. It's no secret that Tether and Circle are making a lot of money by running these operations. And the incentives, the rewards that are generated by this profit, these businesses traditionally go back in the pocket of the issuers. There is nothing bad with that. It's just a business model decision. But we're reaching at a point where we have the ability and the technology to start basically redistributing economic incentives to the population, to holders of the stable coins. And that's the approach that USDM has taken with building our own product. In terms of the landscape, the journey or the transformation, I would call it a V1, a Tether type of stablecoin, a V2, a Circle, or other type of stablecoin where there are strategic agreements for sharing the underlying interest with certain distributors and so forth. We think about Mountain Protocol as a V3 where every single holder of the network is incentivized the same way to hold the asset. In terms of the rest of the market, yield-bearing assets, I think there is a lot of noise. Clearly, there is a ton of product, and that's also the beauty of blockchain, the ability for people to launch products very seamlessly. But there are also a lot of unknowns in terms of what you're actually dealing with. Generally speaking, I categorize them in a few different buckets. There are fiat-backed stablecoin, traditional centralized stablecoins like a Tether, like a Circle, like a Mountain. You then have tokenized securities. They could be tokenized funds such as Beedle by Securitize and BlackRock or Benji by Franklin Templeton. And then the last bucket, the last category, I would call it synthetic dollars. And this could be a product, for example, such as Ethena EUSD. Now, in terms of what it means for the ecosystem, integration dynamics, and so forth, people love stablecoins because of their characteristics, their ability to integrate seamlessly, the composability between DeFi, CeFi, and everything between, and now more and more fintech, neobanks, and so forth. For tokenized security specifically, there is a little bit more friction, and some folks from Franklin Templeton spoke about this earlier. These assets can usually only be transferred between whitelisted wallets, so it makes it a little bit more difficult to get integrated deeply across the crypto network. And then you have these synthetic dollars that carry the characteristics of traditional stable coins, but might have other trade-offs, for example, maybe transparency or risk and so forth. So there is a lot of products in the market. It's ultimately up to us to educate the community. We're seeing also more and more traditional institutions such as S&P, which was also here earlier, discussing about credit rating, risk rating, and so forth. And I'm confident that as time goes by, there is going to be more transparency and the community is going to get more and more educated about these different products and what they mean for their opportunities and their businesses.
Absolutely. Really good note there on educating the broader community on the dynamics of these instruments. I want to pose a question to you, Johannes, about the role of USD on the stablecoin landscape. We could call it dominance of USD in the stablecoin landscape, and I know you've voiced your concerns about this a couple times. Could you share with us a little bit about those concerns and, more importantly, any viable alternatives that you see gaining traction in the space?
Sure. The dollar, now talking about not necessarily DeFi, but the traditional world, the dollar is quite a dominant currency for international trade. but it still is. I mean, I don't have the numbers in my head, but it's probably below 50%, even like globally speaking. Now, in DeFi, that is 99% plus. And I differentiate here between like currency for transactions and something where you look at the currency as a store of value. As a transaction, or transactional currency makes a lot of sense to have as few as possible. It just makes everything more efficient. The issue then becomes if everything is only held in that currency, because that creates very kind of risks which are connected to one economy, which is, let's agree, one of, or if not the biggest economy in the world we have, but it still is a play ball of politics. There's often a lot more internal politics involved in how a stable or a currency behaves rather than external one. I can give you a good example with the Swiss franc. I'm always talking about the Swiss franc all over the world because that's what I'm doing. Like I'm obviously posing that Swiss franc as the alternative to the US dollar, but thinking a bit back of the strength of the Swiss franc. Actually, the strength of the Swiss franc for the Swiss, domestic policies is a problem because Switzerland becomes more expensive. Switzerland is an export nation. Now, what happened, and they've stopped, I think, in 2014, over a couple of years, the demand for Swiss franc from the euro space was extremely high. And that caused exactly those problems. It was not an issue, in terms of, like, for us as holders of these currencies, but for the domestic industry. And the Swiss National Bank actually held that peg, so that the euro-Swiss franc peg was at 120. So they basically said over several years, we are at whatever it takes. We're going to defend that peg. We're going to make sure that the Swiss franc will never be more expensive. Sorry, the other way around. The euro will never be cheaper than 120, Swiss francs. Obviously now it changed. It's substantially lower, but that means that is something which is a purely domestic decision. It is purely national politics. And if you're looking at something like DeFi, which is, I'd say, not necessarily defined by borders, but is a global phenomena and is a global market, and we're all, I think, global citizens to some extent. Only having, currency of one part of the world dominating everything is quite risky. So yeah, so what I'm saying is, as transactional currency, perfect. If it's that high, it's great. We're all thinking the same prices. But then as a store of value, there's alternatives. And the Swiss franc obviously is one. If you look at numbers, if you look at the M2, so the money supply against GDP, the Swiss franc is almost double the size of the US dollar. And that just shows an indicator for that, okay, well, people are actually in TradFi holding that Swiss franc as a store of value to hedge against geopolitical risk. And we just believe we should have this diversity as well in DeFi. And that's why I'm traveling around the world and telling everyone, hey, look at alternatives. Like, you have the US dollar, okay, but what else is there? And what else can we use and what else can we build on?
Absolutely. And that diversification, I think, really, I think it's really relevant to the overarching theme of institutional adoption and displaying that sense of diversity in the landscape of stablecoins, I think could really boost what we're looking for in terms of institutional integration. I want to switch gears a bit to the infrastructural aspect and pose this question to Jen. From your vantage point at Chronicle and the services you serve up in terms of Oracle-based verification, we know that trust and credibility is a really huge factor in terms of institutions really feeling comfortable with this space and adopting it to the level that we would like to see. So from your vantage point, how are you seeing infrastructure playing a role in achieving this level of trust? Are there any gaps that you think can be filled or are already being filled in that regard?
Yeah, I think zooming back to 2008, right? The 2008 financial crisis was, a crisis in many things, but a crisis from a lack of transparency. And a lot of the people that are now working in crypto and blockchain, lived through that. Maybe, maybe they were in high school, maybe they were just getting out of college, trying to get a job, and the job market was awful. And they, were impacted from the financial crisis in some way. And they looked at this alternative blockchain-based economy as a way to improve upon this opaqueness that existed in traditional finance. So I think looking at kind of like the foundations of what, a stable coin or any crypto asset brings within DeFi is this level of transparency that is just not available with traditional financial assets off-chain. And so I think, the institutional community sees that value, but they also see the opportunity to increase, distribute more product, increase their customer base, and offer products at lower price points. So it is a technological advantage that is, helping to drive and convince these institutions to look within the world of DeFi. But I think, from a practical perspective, it's like the gains in, in their business and their growth. So with that, on the infrastructure side, what we're doing, from an Oracle perspective and a verification perspective is allowing that kind of third-party neutral attestation that value that exists anywhere, whether it's off-chain in a fund that's being tokenized and brought on-chain and then being portaled through all these lending protocols that we use, that we're not just relying on the issuer's reports, right? Because we saw that happen with the 2008 financial crisis, right? We believed in the big banks, and we didn't have the view into the types of loans they were doing and kind of the reckless risky practices that were going on. Now, can we change everything? No, but with infrastructure that provides this additional verification, we're improving upon what has existed. So I think that adds to institutional confidence, that adds to the user's confidence when they're actually transacting with maybe a tokenized stablecoin or some other asset in their favorite lending protocol. It's providing regulators with more tools they could look to say, this is a way where we can understand what is taking place, which is good to protect consumers, which is important to their job. So I think for all the stakeholders that are involved within, this economy, the issuers, the users, the protocols, the regulators, transparency is like just, the engine that builds that confidence.
Absolutely. And I did want to touch a little bit on the decentralized aspect of issuance of the M0 protocol. I know that you guys have taken a different approach to stablecoin issuance, but still maintain institutional grade reserves. And I wanted a little bit more insight from you, Jacob, as to how you're balancing trade-offs in designing and running such a protocol. How are you balancing, incentives for minters and structural stability and so on? What are the design decisions that you think have been made to get to this point?
Yeah, it's a great question. Thank you. It's interesting. For us, our focus is really on helping developers, right, and entrepreneurs and applications embed stablecoins, as I said before, right, into their applications and building stablecoins on top of the M wholesale stablecoin. The way I view the Minter network, right, and the open side of that network is really an option in terms of regulatory coverage. So it's not necessarily a function of convincing issuers to come onto the network and issue M as a raw asset. But for us, can we have geographic diversification of issuers, so we can serve customers in different jurisdictions. And then the other side I think is really important is because M0 is a many to one-to-many network, and with the protocol being that one, this immutable protocol at the center, is giving large distributors the option, but not the obligation to become an issuer. So I think it's kind of the best of both worlds in that there really shouldn't be a trade-off here, is that if you want to go work with a centralized entity and purchase M, right, which generates it from the decentralized protocol, you have that option, and it looks like, we're working with Circle, right, directly, right? But in the future, right, mentioned like the economics of Minter. If minting becomes a very profitable business, that is, like there's a spread between the underlying collateral rate and the rate at which issuers pay the network to issue M. Well, now, if you're dealing with a centralized entity in a single issuer network, if I'm on the other side of that and I'm earning yield from the protocol, I am locked in, I have vendor lock-in. So these guys can start to squeeze me on the yield that's being distributed downstream. But if I have an open network and the option to myself become an issuer, those economics can never be taken from me. So I don't see it really as a trade-off, but really as this option for integrators to always recapture the full piece of the pie back for themselves. So I think that the incentives are really are pretty well aligned across the network, and it's not too much of a hurdle for us personally.
That's very interesting. And I think that as someone who deeply participates in governance myself, I'm also really interested in how M0 views the role of governance in this aspect. I think it's pretty critical because governance-driven decisions are used to decide on like issuance and rebasing mechanisms and so on. From your perspective, do you think that governance is maybe creating a little bit more friction for potential institutional adoption? Or do you think that in the long run, decentralization always serves like that core benefit?
Yeah, it's a really good question. I do think that it does create initially like extra friction. But that's, there's a trade-off there clearly, right, between, building a decentralized network where you want to build it as narrow as possible to have the governance control as few parameters as possible, right? Because it's key that if M is a building block, you want people to have comfort. So it's an immutable asset, so that cannot be changed by governance. But there are certain parameters like the interest rate paid by issuers to the network or the downstream yield that is distributed by the protocol. Those are kind of the two key parameters. And then, of course, there's being added as an approved earner in the ecosystem because M only distributes yield to whitelisted earners. But those are really narrow parameters. So I think there is a little bit of a hurdle getting people comfortable with this. But when you realize that the parameters that are being, that are governed within the protocol itself are really narrow, I think that people can begin to overcome that. And I do think the trade-off is worthwhile to have this like open network. And I think over time, people will begin to become very comfortable with that.
Absolutely. I think, the conversations around like where governance minimization is most relevant here and having sort of that approach to progressive decentralization, but still making it approachable to institutions looking to integrate. I wanted to go back to Emanuele and talk a little bit more about USDM and distributing yield to users. Can you share a little bit more about how USDM has managed to gain so much traction because of that decision that is quite in contrast to a lot of what the competitors are doing in terms of yield distribution, and how this, you think, potentially serves to increase the level of institutional adoption that we're seeing for stablecoins?
Sure. So first off, the great thing of crypto is that we have all of these interesting models coming into the market. People can explore, play around with the right technology until we find product market fit. And product market fit doesn't need to be one model. It could be multiple. So I think we have to appreciate all of these different views and structures that are being presented here today. For us specifically, we chose the good, old, boring, centralized route. We're a centralized stablecoin issuer. We're a regulated one. And the view, again, is just to see Mountain Protocol like a financial institution, essentially like a bank, whatever you want to call it. That's how we think about ourselves. As such, we need to make the experience for our customers as seamless as possible, because we see, again, our customers as my mom of my friends, the common person that is looking to save a few bucks, or the sophisticated investor is looking to access an easy-to-use product that is going to add value to their workflow and to the experience seamlessly. So the design route that we chose was basically trickling down from that, wanting to build a dollar that was simple to use and that added value to anyone that was holding it. In terms of the implication of the products, well, these days Circle, Tether, and other stable coins are embedded across all different parts of the crypto network. Whenever I think about the crypto network, to me that's DeFi, it's CeFi, and more it's fintech, banking, payments, and so forth. So for a stable coin to be successful, I think rule number one, it needs to be able to tackle and integrate deeply and seamlessly across all parts of the crypto network. Tether and Circle have been able to build huge moats in terms of liquidity, synergies with applications that are part of the crypto network, and more. Our goal is to basically build a competing network, give an alternative to users so that whenever they're running a stablecoin-based workflow, they have an option to get incentives derived directly through their stablecoin in a very low-lift, low technical integration type of dynamic. On that note, again, it could be working with the decentralized applications, lending protocols, decentralized exchanges, derivatives exchanges in DeFi markets. It could be working in CeFi with OTC desks, exchanges, prime brokers, custodians, again, anyone touching a digital dollar. And more, we are having conversations and discussions with the fintech, neobanking, and payment space. I think the fintech and neobanking payment space is very attracted to something like USDM because there are no liquidity restrictions or requirements on their end. If they decide to build a product, a dollar-based product that pays rewards, that pays interest to their customers, they can do it in a very seamless manner thanks to our stablecoin. So that's how we think about the market. That's how we think about economics incentives and how they trickle down to the community across different parts of the ecosystem. Again, in the end, wherever you have an unproductive dollar, you now have an asset that is productive, that is equally safe, and that ideally is going to be there for you across all different parts of the crypto network.
Absolutely. I think, one of the themes that I'm seeing sticking out in this conversation is that theme of making things a little bit more approachable, making things more transparent, and also being experimental in approach, but still having a sense of safety for institutional adopters. And I wanted to go back to Johannes and talk a little bit about collateralization, because collateralization is really what gives stablecoins their credibility, but they could also be a limiting factor in terms of scale. So I wanted to hear from you how you think the landscape of collateralization in CDP-backed stables is going, and what could be the more optimal framework for selecting collateral for CDP?
That's a hard question. That last part is probably a bit in flux. I think you have to kind of divide that into three parts. For thinking about collaterals for stables or CDPs or for even, and one part is really that liquidity, right? Like how liquid is a market, and how deep is a market, and how large is a market, because that directly is connected to how much you can scale a stablecoin. Because CDPs in its original form are not very capital efficient, because you have a capital overcapitalization. This is, Jen, you probably know that very well from the Maker DAO times, really. Where that was started. But then there's more to that, right? And that's obviously like where crypto is the most liquid markets in crypto right now. Talking about Bitcoin, Ethereum. A second part is yield. How expensive is holding that collateral, collateralizing that, and that's where, for example, that whole discussion regarding ETH versus staked ETH comes in, where you can actually reduce as a borrower your costs by being able to use staked ETH as a collateral. And then the third part is, and this is actually something where I think Stakehouse Finance coined this idea with this, redeeming a stable coin into a higher order currency, right? Where how easily do you turn, and this is actually something which is, a discussion we're having in the Frankencoin Association currently. What is the best way to move or to change your stable into fiat? In dollar, it's easier because you can go in the USDC route or use the T route. In Swiss francs, you don't have that option because it's the regulatory-wise, it's impossible to issue a centralized stablecoin in Switzerland. So that is a third big question which is developing on where you can build ways, and that's where things like tokenized bonds, tokenized RWAs, and it's like two different types of tokenized RWAs. On one hand side, like this very liquid kind of things, which allow you to move out and in of the system, which allow you to scale quickly. If you scale slowly, I believe any asset really works. But if you have to move $1 billion in like this or out like that, you need very, very deep liquidity, not on a stable coin, but on the way which connects it in some form or the other to the underlying fiat. Now, the last part is the yield, and which is connected to the risk, where I am of the opinion that having a wider variety or wider range of collaterals can add something in terms of both yield and risk. And risk, what I mean by that is the biggest, this is a panel, so if you don't agree, please challenge me on that. One of the biggest risks I see with the traditional CDPs is those flash crashes where let's say if you have only crypto-backed stables, that correlations tend to spike up in those environments. I remember very well March 2020, for the ones here who've already been in the space, 5 years ago, shit. When everything crashed, I think 60% over the weekend, right? And everything correlated. And that is not sure, how did MakerDAO do back then?
We're still here. Yeah. Solvent. Yeah.
Solvent, all good?
Yep, all good.
Well, amazing. But it was, I really caused quite a bit of issues for quite a bit of people. But basically, how do you solve that problem is by adding non-correlated assets. Now, okay, you can argue, okay, everything is going to be correlating for some reason or in some way in those environments. But how we do it, we have this beautiful thing in Switzerland called the Swiss blockchain law, which allows you to issue equity on chain. So it's not tokenization, but you take a company, you make a capital increase, and it's as a token. And then if you have fairly large SMEs, which are in very boring businesses. I mean, Frankencoin has two. One is doing admin for payroll, and the other ones they're building IT services for the government. Nothing to do with crypto, right? And that is a very, very good diversificator in helping you make the system more secure in those choppy or extreme environments.
I would just add, I think this, goes back to kind of the great attributes of, what is the blockchain and having this, ledger that everybody has access to 24/7. We can, consider any type of asset, whether it's a lot of liquidity, low liquidity, it's understanding the risk profile and understanding, what the trade-offs are of that risk. And what I mean by that is, from an Oracle perspective, creating an Oracle or a price feed for any of the, major tokens, very easy, right? Because there's a lot of liquidity, a lot of exchanges that list those tokens. So it's quite easy from creating a data model and informing the price through an Oracle. When you get into these lower liquidity and kind of newer assets, that's where risk increases, right? Because in a market crash.
But what risk increases? The risk of not knowing the price?
Yeah, so the price dislocation could be quite extreme quickly, right? And if there's not a lot of exchanges or, volume on that asset, it's sometimes unclear, was there, some type of bug, a hack, or was that price that's being represented accurate in that moment?
That's why we don't use oracles.
Yeah, I mean...
That's exactly that point, right? Where you have those extreme environments and... Frankencoin solves that by not having them, and then instead, you have a reverse Dutch auction, you have basically its own price finding, which is slow, so you can't liquidate immediately. but you somehow try to avoid that mispricing. Because that is what it is, right? Even the underlying asset might be very, very solid, but because there's no liquidity and you are forced to rely on like a liquid price, behaves to very unfavorable outcomes.
Right. I mean, it is a deeper discussion, but like at that
That's why we're
point,
here.
yeah, we have 4 minutes left. But then it goes back to who is taking on the burden of risk, right? If you don't have an oracle that's providing a protocol with a price in real time, and you have an auction system like yours, well, then the price might be such where that protocol is taking on a lot of debt and becomes insolvent, right? Because the price was what it was supposed to be, and it wasn't getting liquidated in a quick enough manner to make that protocol solvent. So there are two sides of
There are, right? There are, and it's obviously like only having that part doesn't work. It needs to be embedded in a set of things which allow you to actually have that. So what do you really need? You need to be able to bridge the time until you have a price. That is really what it's all about, right? Either if you have an oracle, that needs to be can be very short, with the risk of when I do speeches, I always have draw this imaginary line where you have the crash which goes down, and then a day later it comes up again, which is what happens in probably 95% of the time. And then actually liquidating down here is not optimal, so you would have better waited a day. And in that sense, the oracle basically part behaves better than the one with the oracle. But yes, you're right. If you have an asset which keeps going down, and then you want to obviously be able to liquidate as early as possible to avoid what you just said, to avoid that bad debt which you potentially have to carry until you have a price at which you can liquidate.
I would just toss in there.
Please, I mean, it's
maybe a little bit of a spicy. I think once you're having this conversation, I think you've already lost in the sense that it's not suitable collateral for a stable coin, in a scalable manner. Those types of assets where you could have these massive liquidity dislocations, and neither Oracle nor an Oracle-free Dutch auction system will solve that if an asset fundamentally lacks the value and therefore the liquidity to liquidate. Yeah.
Exactly.
The promise of more diverse types of collateral is really attractive. Talking about like tokenized credit, some people talk about real estate, but I know that there are still a lot of technical structural barriers to these actually being more viable forms of collateral for CDP-backed stablecoins. So I'm really looking forward to how each of us and our respective projects evolve in the coming days, weeks, months, years to meet the growing needs of institutional trust and compliance. I wish we had time for like one audience question. If anyone has like a quick fire question or comment, I think we have just 1 minute to spare. But if not, I think that we can wrap it up right here. We've talked a little bit about the dominance of USD in the stablecoin landscape. We've talked about decentralized and centralized issuance. We've talked a little bit about the role of infrastructure and how it's serving to bridge trust gaps for institutional adoption. And we've talked about yield and how that is impacting adoption of stablecoins, both on the DeFi and TradFi side. Thank you again to our panelists for sharing your expertise today. Thank you to the audience for listening. I myself am very excited about the promise of, more extensible applications as it refers to stablecoins and just seeing more transparency integrated at every level, from the monetary level to infrastructural level and so on. Thank you all for being here, and that wraps up our time.